and welcome to a discussion on assets used more than 1 year to operate the business. After viewing this video, you'll be able to determine which expenditures and costs are reported as an asset and which are reported as an expense. You will be able to properly account for software cost and research and development, explain why long-term assets are reported at historical cost, and define impairment of long-term assets. Long-term assets are used more than 1 year to operate the business with the goal of producing probable future economic benefit, most often in cash. Long-term assets are reported on the balance sheet under the categories of property, plant, and equipment, intangible assets, or natural resources. Property, plant, and equipment is also referred to as fixed assets or plant assets, and they have physical substance and are reported at historical cost unless impaired. Fixed assets are reported on the balance sheet net of the cumulative cost of using the asset. The cost of using property, plant, and equipment each period is reported as depreciation expense on the income statement. Amounts paid after the company begins using an asset to produce revenues are called subsequent expenditures. Subsequent expenditures are included in the cost of property, plant, and equipment if the useful life is extended or it brings efficiencies that lead to additional future benefit. Property, plant, and equipment is reported at historical cost. The historical cost reported on the balance sheet includes the purchase price and all amounts paid to get the asset to the point where it can be used to produce revenues. The cost of getting land ready to use often includes sales tax, title searches, transfer costs, attorney fees, real estate commission, bulldozing to remove old buildings from the land, survey fees, and past due property taxes. The cost of getting buildings ready to use often includes sales tax, title search, transfer cost, real estate commissions, attorney fees, any remodel before use, architect fees, and past due property taxes. And the cost of getting equipment ready to use often includes sales tax, delivery cost, installation cost, and all training costs before using the asset to produce revenues. Costs incurred as the company uses to produce revenues are expensed. Intangible assets grant an exclusive right to do something and have no physical substance. Intangible assets are reported on the balance sheet at the amount paid to outside parties. This cost includes consulting fees, attorney fees, filing fees, and all costs to obtain and successfully defend the right to use the asset. The amount reported on the balance sheet is the cost paid to outside parties, net of the accumulated amortization expense of using the asset. The cost of using intangible assets is reported on the income statement as amortization expense. Internal cost, primarily salaries related to obtaining or developing intangible assets, are expensed in the period they are incurred. The cost of an intangible asset reported on the balance sheet is often minimal compared to the related potential future cash flows, which is the current fair market value. Fair market value is not reported on the balance sheet for intangible assets. For example, the fair market value of the trademark Golden Arches owned by McDonald's Corporation is millions of dollars, and the cost reported on the balance sheet is less than $1,000, which is only the payments to outsiders to obtain and protect the trademark. Let's talk about the intangible asset goodwill. Goodwill is the amount paid to acquire 100% of the company that is greater than the fair market value of the net identifiable assets acquired. Tangible assets used with goodwill create higher future cash flows than the individual assets used separately. The buyer is willing to pay more for the total company than the total fair market value of identifiable individual assets because the business is established and has the ability to generate more future flows than the separate individual assets. Intangible factors such as a good management team, a good location, and name brand recognition or customer lists are all part of goodwill. Goodwill must be purchased to be reported on the balance sheet. Internally generated goodwill that naturally develops as the business grows is not reported on the balance sheet. This is because no exchange occurs and it is difficult to determine an objective, reliable value. Identifiable assets such as patents and trademarks are expensed over the time the assets are used. Goodwill is an exception to this rule because goodwill has an indefinite life and is not used up, so it is not expensed systematically over time. Goodwill is tested periodically to determine if impairment or permanent loss of value has occurred. Goodwill is reduced to estimated fair market value if fair market value is lower than cost. An asset cannot be reported on the balance sheet unless there is a probable future economic benefit. Emphasis on the probable. The future economic benefit of software development is often uncertain until a significant portion of work has been completed. Since there is a lot of judgment involved in determining if benefit is probable, FASB provided some rules for reporting an asset or an expense. Before technological feasibility, all costs are reported as an expense. After technological feasibility, all costs are reported as an asset, called software development cost. Technological feasibility is achieved when the product works, a market exists, and the product in development is expected to be sold at a profit. Research is the attempt to find new knowledge. Research is followed by development, which is the translation of new knowledge into a product or service. Costs spent for research and development follow the general rule that cost must provide probable future economic benefit to be reported on the balance sheet as an asset. The expectation of probable future economic benefit often varies from company to company and is difficult to substantiate. To provide consistency, GAAP requires research and development costs incurred prior to production to be reported as an expense, regardless of the probability of success. Costs incurred to improve products currently in production and generating revenue are reported as an asset because future economic benefit is probable. The previous product is already generating revenues. Research and development performed for others is treated much like long-term inventory, and revenue is often accounted for using the percent of completion method. The payment for doing the research is the expected probable economic benefit of the asset. A company may purchase in-process R&D activities from another company or as part of the purchase of another company. Purchased R&D is reported as an asset and valued at fair market value at the time of purchase. If technological feasibility has been achieved, the R&D is considered developed, and it is reported as an intangible asset and amortized over the expected useful life. If technological feasibility has not been achieved, it is considered to be in-process R&D and is considered to be an intangible asset with indefinite life. Indefinite life intangible assets are tested for impairment. The asset is removed from the balance sheet when the company determines there is now no future economic benefit. Natural resources are reported as long-term inventories when sold directly to customers or used to manufacture products. The cost of natural resources is reported as cost of goods sold when the natural resources are delivered to customers. Common natural resources are metals, timber, and oil. A company may be obligated to incur costs associated with the disposition of property, plant, and equipment and natural resources. An obligation to restore land to its original condition after drilling or mining is an example of an ARO. The cost to restore the original asset is added to the cost of the original asset, and a liability is reported on the balance sheet. One of the most important responsibilities of an accountant is to determine if an expenditure should be reported as an asset or an expense. The rules under GAAP follow the basic principle that an asset must provide probable future economic benefit for a period of at least 1 year to be an asset. Costs are expensed when there is no probable future economic benefit. Costs incurred more than once during the year, by definition, do not provide enough future economic benefit because the benefit runs out and must be purchased again. Take a moment and review the costs that are typically capitalized and reported as an asset on the balance sheet. The cost of property, plant, and equipment generally includes the purchase price, all costs to get the asset ready for use, and all costs that extend the useful life or improve efficiencies. The cost of intangible assets includes only amounts paid to outside parties. Software development costs provide probable future economic benefit after technological feasibility has been achieved. And R&D related costs are considered to provide probable future benefit only when the cost is related to a current revenue generator. Pause and review these important guidelines. Costs that are generally reported as expenses include routine maintenance or repairs that must be paid more than once a year, the cost of salaries and the use of facilities related to developing intangible assets, software development costs before technological feasibility, research and development costs before a marketable product exists, and advertising expense due to the uncertainty of probable future economic benefit. Take a moment and review these important guidelines. Reporting assets at fair market value is preferred by most users of financial information when fair market value is reliable. Reliable means the amount can be verified objectively and more than one person would arrive at the same amount. A value is considered not reliable when people would arrive at different amounts. There is currently no reliable method used by accountants to determine the estimated fair market value of long-term assets, and fair market value is often situationally specific. United States GAAP requires long-term assets to be reported at historical cost, with the exception of some long-term investments or if impairment occurs. Most users of financial statements are satisfied with reported values of long-term assets at historical cost. The fair market value of individual assets does not typically impact a financial decision unless the asset is intended to be sold in the near future or the fair market value, which is also the probable future economic benefit, is less than cost. Long-term assets are reported on the balance sheet at historical cost unless there is a reliable and objective fair market value, or the asset's ability to generate probable future economic benefit, which is also fair market value, is less than the historical cost, or probable future economic benefit is generally the sum of the expected future cash flows generated from the asset. Assets cannot be reported on the balance sheet at an amount greater than the expected probable future economic benefit. An impairment occurs when the historical cost is greater than the estimated future economic benefit, or future cash flows. An impairment is a loss of ability to generate future cash flows, a permanent loss of ability. Impairments can be caused by adverse business conditions or new competitors. When impairment occurs, the value of the asset is written down to fair market value and an impairment loss is reported on the income statement. After viewing this video, you will be able to determine which expenditures and costs are reported as an asset and which should be reported as an expense, properly account for software and research and development cost, explain why long-term assets are reported at historical cost, and define the impairment of long-term assets. Please go to StudyMyAccounting.com and work through practices you learned for examples of how to apply the concepts discussed in this video. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is much appreciated.